A glut of buy orders, no trade. Is this not going to fly?
I think the answer is, look, it's obviously going to fly. It's obviously flying already. But more fundamentally, the Tokyo Metro IPO is embraced very warmly because it's a cash cow. This is the high dividend, stable cash flow generator. Unlike some of the other utilities like the gas companies or the electricity companies, this thing has very low operational risk. So whether you're Mr. Watanabe or whether you're Joe Sixpack, whether you're the global investor or an institutional investor, this is a great share to own.
So this is an interesting contrast, right? Because earlier this morning we were talking about how Hyundai Motors India IPO yesterday in Mumbai, that flopped, right? It's not because the institutional money wasn't interested. They liked the story, right? Indian retail investors, though, that was very different. But in the case of Tokyo Metro, though, at what, 3.2 dividend, right? Retail investors in Japan should love this as well.
But this is the point, Martin. And, the key point is that the dividend outlook is actually very stable because the operational performance, the steadfast cash flow generation, this is Tokyo. This is a positive demographics. As you know, the population of Tokyo basically grows every year by just shy of 1%. As a result of that, the demand for the metro's core businesses remains very strong. 80% of all the revenues is the bread and butter train service business, and that's extremely stable. So the dividend is good and may even go a little higher.
Yeah, and Jesper, so certainly there's a lot of talk about the fact that it is seen as a stable investment, a value play, but perhaps one of the knocks on this particular company into the longer term is its earnings growth potential. Do you see much upside on that front?
No, the answer is, not really. Like I said, it's a utility. It's a high cash flow generator. It's not a growth story in the standard equity market sense that, oh my God, they're going to take on the NVIDIA. No. This is a high dividend, stable cash flow. It's basically a bond that's going to give you solid performance.
Very heavily oversubscribed, a lot of interest from overseas investors. So what is this telling you about the Japanese market more broadly? And if we do see a really strong performance, is this potentially going to unleash the animal spirits when we talk about the IPO market in Japan? And I'm thinking particularly about Kioxia, which of course is a name that has been bandied about in terms of a listing.
It's interesting that you compare it to Kioxia, the semiconductor part that used to belong to Toshiba. And that's a completely different story in the sense of that the global semiconductor market is a bloodbath. It's a red ocean, excessive competition. Everybody's adding capacity at record speeds. In contrast, there's only one Tokyo Metro system. And that one Tokyo Metro system in the greatest metropolis in Asia is going to continue to maintain its monopoly. So if you're a foreign investor and you're looking for a benchmark, high-yielding anchor position in Japan, it's exactly where you want to be. And semiconductors is a global business. You've got no moat. Nobody's going to protect you. And from that perspective, I think this sort of semiconductor IPO market in Japan is going to continue to be very, very difficult.